Hello. Well, thank you so much, everyone, for coming. I'm glad not to see the room empty, actually, because this is a very much relatively newer topic that we have been tackling in because we come from traditional finance background, and there's been a lot of growth of options in CFI, but not as much in DeFi. So that's why this is the topic I wanted to talk about here at Ethereum conference. A little about me. I work at Ledger Prime. Uh, Aside from Ledger Prime, I'm also a faculty professor at NYU Tandon, New York University, where I teach a course on blockchain and distributed technology. Previously, I was founding director at Republic, where I started Republic Crypto. I'm an angel investor in over 30 projects, and I was a very early employee at Consensus, where I helped launch Singular DTV, which in turn to be Breaker. So I've known the team for a very long time. I still have a great relationship with the team that I take a huge pride at. Ledger Prime. So Ledger Prime is a multi-strat hedge fund deploying a quantitative and systematic investment approach. We have over 150 million under management and have worked and invested in over 30 DeFi projects till this date. We only started actively investing since last year. The fund started in 2019, but last year was our entry to the DeFi space, where we kind of realized that there's so many emerging trading protocols where we could take our expertise and provide the liquidity, groundwork, frameworks, and whatever we could do to build up the space ground upwards. We're one of the largest liquidity providers on several CeFi platforms such as Deribit, Bit.com, LedgerX, Paradigm, and CME. We're also active users and investors in several DeFi options platforms such as Ribbon, MOE, Open, Dopex, Hero, and D-Trade. We provide consistent and predictable market liquidity, ensuring high liquidity, market depth, and transparent price discovery, which allow investors and participants to trade more efficiently. So to give the overview of the CeFi options market, right? It's very much important to know that BTC options only started in late 2019, and Ethereum options started this year. But there's been a huge exponential growth, as the two charts out of skew kind of give you the frame. What's the reason behind it? Even though the volumes have come down from the peak from earlier this year, it's still grown substantially. And this does not include the OTC market or non-BTC ETH market, which sometimes can be larger in volume and open interest. Growth is very much attributed to influx of sophisticated funds utilizing options to hedge, gaining leverage exposure. So every single time you hear of Goldman Sachs or any of the traditional funds investing in ETH or buying in ETH or whatnot, they're trading derivatives. They're not buying into spot markets, but because they're trying to ensure their positions well. And that has to say a lot because these are fully collateralized position. So that kind of sometimes gives them the advantage to either short the market or long the market. We have started seeing manipulation in BTC ever since more active funds have started to get involved, like Elon Musk it's a huge example in front of us. But I'm not here to talk about BTC, but wanted to give an overview on more of the institutional involvement just means more of manipulation of the market. Aside from the funds having the exposure, it's also the miners, lenders, token foundations utilizing options to hedge and generate yields via selling options. Something that we've started very much actively talking about. I know Sushi gave a presentation yesterday. There's a couple of other protocols that have started doing discounted sales. And one thing that, we were trying to tell them is they can utilize their treasury to trade options in order to generate their revenue that they're trying to look out of, these token sales. So you can utilize, options of whether it's DOT, Sushi options, or whatnot. Structured products that focus on yield enhancement like shark fins or double or no touch options have also contributed to the overall growth of the market. So this is the traditional market as a blueprint for growth. When I say traditional market, is the traditional financial market. We all know that crypto is here to stay, and it is its own asset class. By now, it's gotten its distinction very much. In other asset classes at scale, options trade 30 times the size of spot markets, which is actually very important to note because comes a point where derivatives / options are driving the price forward of the spot. And we think that crypto will be absolutely no different. The charts here represent the speed of growth of derivatives for other asset classes, as well as the size of derivative markets relative to spot. This is, So this is how basically the entire CeFi options market structure kind of look like. This is just an example out of Paradigm that we actively market make on. But as you can see, the expiration dates are open, the bid and ask, the strike price, dates. You can basically go and pick an option that you think would be willing to your appetite of risk, and based on that strike price, you can buy that option. So I've made it sound like simple, but it looks a lot like traditional option markets. This is how actually like CME also looks like. And these are separated by different expirations and strikes. Given that there's so many different options to choose from, you can imagine that options are orders of magnitude more complex than spot and futures. So this is a very tiny example of like one order book, but this goes on and on and on. The fact that we're still like very much in early stages for CeFi, the order book for DeFi is way much more like smaller than this. But market makers who have consistently have to maintain two-way liquidity for all options contract. Liquidity is kind of like dispersed. It's extremely technologically and computationally intensive, given the automated models have to calculate prices for each option on a high frequency basis and update risk and inventory parameters. One thing I would like to make a point that the handful of DeFi options protocols that we're working with are basically taking data off of each other because this is that much of a complex system to build. So brings me to topic of the day, state of derivatives in DeFi markets. It's been a very promising field, which we're personally very excited about because the on-chain metrics that crypto basically promises could solve a lot of issues that traditional markets face. And that's something that's like even very much extended into derivatives as well. So far about 2.5 billion is locked up. It's TVL has been allocated to DeFi derivative projects, specifically built on ETH. And project themes in the decentralized derivatives space include options, futures, insurance, and prediction markets. The total market peaked almost to 4 billion a couple of months ago. However, the rise of new two-layer solutions on Ethereum has also increased volumes, and TVL locked on DeFi derivative protocols like DYDX, Starkware, helping DYDX, and then similar, like, the UX that helped solve CeFi exchanges. However, from our personal perspective and something that we've noticed in the market's perspective, we haven't seen much of like the options growth other than Ribbon Finance and Open so far. So the current and why there hasn't been much growth other than Open and Ribbon. Ribbon basically takes Open's data. Reason is wide variety of possible options contracts like expirations and strikes, making it computationally expensive to build liquid markets on chain. Necessity for order streaming or cancel or replacing of orders, making it very expensive for gas costs. Like we've had this discussion within the industry over and overall. We think that maybe 1559 probably could be a solution for that. Let's hope. Robust on-chain portfolio margining and liquidation system. It is a lot more tedious than it sounds. And Binance, Coinbase, all of the other CeFi platforms have taken years to build it. With DeFi, we've just gotten started like last year. And then option market makers, people like us, need a liquid on-chain Delta 1 for spot, perps, and futures to hedge options risk. So that's why a couple of days ago, actually, Kyle Samani on Twitter raised a very valid point on how perps need to succeed before options in order for the entire derivative space to grow maturely in DeFi, and he was absolutely right about that. And that kind of most of the projects like MOE, Open, took as a feedback, went back and said, we need to solve for perps first, so market makers like us has an option to hedge against the options that they're trying to sell. And then the application of XYK like AMM models for DeFi can lead to severe and permanent loss. Not a single day goes by where we're not bitched by a project that is trying to come up with a solution for AMM, but come up for a solution for impermanent loss, but hasn't really. We're hopeful for it. So this is the entire current landscape that of DeFi ecosystem that says, we're like trading DeFi options. When we're saying DeFi options, technically that basically just means Ethereum, Matic, Aave, Sushi in some cases. But main of the market cap is being led by Open and Ribbon is taking Open's data. So, so like I said, like Open has the on-chain order book, and Hedged, Octus, and Pools liquidity like Hedged and Primitive and Siren. These are projects like still in development, so we're very much interested to see what comes out of it. Open, and then the other thing, this is the other hurdle that as market maker that we've started to face is most of our positions on these DeFi protocols are fully collateralized. That's how options trade anyways. But Open recently has decided to launch partial collateralization, which is kind of a big deal for the industry as well, because it makes it very difficult for capital utilization and ROI perspective for us, because we have to completely lock our capital in order to trade that position. CeFi offers margin, there's a bit of leverage, and then most of the positions at max are like 30% collateralized. So that's a good case for Open going on these days. So just to give on the work that we do for these DeFi protocols, I've picked out three examples, three of the protocols that we're helping market make or set up the framework or set, or and have invested in as well. I've mentioned Open a couple of times already, but it's the largest DeFi options protocol, enabling projects such as Ribbon, Opeth, and Gamma to integrate and use open standardized products. They enable partial collateralization, which makes it extremely capital efficient at this point. And then robust liquidation engine designs enables users and market makers to provide increased liquidity. There's a reason their notional value was at 530 million just as of last week since their inception, which is an excellent number for a protocol that just launched last year. The other one is Ribbon Finance. Ribbon was just an idea last year, and Julian launched earlier this year. We're one of the largest and initial liquidity provider for Ribbon structured products. They generate yield through their structured products through on-chain option contracts using Open's protocol in wrapped ETH or BTC. Ribbon's initial contract, the fact that market makers are initially buying and not selling options, and thus there's capital efficiency for market makers, it's less of a concern, and as well as concentration of stride liquidity makes it easy for us and other market makers to keep on providing liquidity on Ribbon in size akin to C5 markets. The other case is MOE. We are an investor and future liquidity provider in MOE Finance, even though it's currently building on Solana and they are trying to tackle perps first. It can be used a guide for like existing or future DeFi options protocol to be built on Ethereum. So if any one of you want to take a stab, please be our guest and do it, because I think the Ethereum network could use a product like this. So far, we've only seen a separation of DYDX and then Open. We need a combination. What MOE is doing, it's a hybrid AMM and order book model along with course margining and liquidation engine. It's starting with, like I mentioned, robust perps market before options, enabling market makers to better hedge in a capital efficient manner. And my last example is Dopex. This is being built on Ethereum protocol. We are an investor and liquidity provider in Dopex. Dopex relies on delegates, professional market makers with deep liquidity within the ecosystem to help and price and stabilize their options. This is a good thing because it keeps the market extremely stable and within the certain parties, kind of, what even proof of stake is, going after. It will launch on Optimism mainnet to minimize fees and transaction times. Rebates for option riders in case of losses are through DPX tokens, so no chance of permanent loss in any shape or form. And this also ensures superior returns in comparison to riding naked options. So the necessary attributes for DeFi options markets, right? What is really required in order to create one, build one, and make a very efficient protocol. Portfolio margining, cross margining obviously, and liquidation engine enabling partial collateralization. This enables greater capital efficiency. I won't say no collateral should be the answer to it, because we are still very much early on with on-chain metrics. So But like if 30 to 40% is something that a protocol could offer, I think market makers are very much receptive to it. The ability to delta hedge for option market makers via robust spot, perps, or futures, just the way that CFI exchanges have managed to like introduce a bunch of different products under one umbrella. So the market makers or traders or funds have the options to use multiple products to hedge against one each other. That's something is, sort of also needed in DeFi. Efficient protocol in terms of speed and cost, like layer 2 solution. We already know about this, enabling full order books. And then if AMM model, the ability to deal with impermanent loss via theta decay, as well as capital efficiency. And then obviously a very robust community of professional option market makers enabling accurate pricing and deep and consistent liquidity. There is no shortage of capital in crypto at this point, and most of the market makers that you would come across or you have come across is willing to provide the liquidity. It's just that everyone is looking for two answers: the collateral required and solution to impermanent loss if it's an AMM pool. And that's all I have for today.